it's always great. Ooh. I will say it's always great to be with the Connecticut CPAs. I think I joined and gave a brief presentation back in February to your board about what would be happening. And so I always love those. Let's come back and see how right I was. One thing I'll say is, I did during that long time that I worked on the Hill, I did at one point do a stint for one of your fellow nutmeggers, Congresswoman Rosa DeLauro of Connecticut, represents around the area of New Haven. She's now the top Democrat on the Appropriations Committee, and she was one of my first bosses in DC. So always great to come back and talk to folks from her home state, and obviously I'm a tri-state guy myself, originally from New York, and that's where I spent most of my time working for members of the New York delegation. So always great to come back and chat. Obviously, we're gonna dive into a number of issues now. There is I will say quite a bit of detail in some of these slides that we might not have time to go into, but I will make sure to share with you, April, the slides themselves so that you can distribute that out. And obviously, if folks have questions, we'll have time at the end. And if there's anything that seems really pertinent or pressing, April told me that she'll be watching the chat to kind of just interrupt before I move forward if there's something really pressing. But then the other thing that I would say is we're always available here at the end of this. You'll see my email address. We've got a whole team of tax policy folks who are going to be working through the law. So if there are other questions that you have that you don't get a chance to get answered or that I can't answer for you, we're always happy to follow up afterward. So let's talk about where we're at. Here in Washington, we've got just about a week and a half for the House, at least, until they begin their long August recess. We've got maybe another 2 weeks, possibly more until the Senate starts. But kind of a lot of the big storylines of the beginning of the year, the beginning of the Trump administration, are kind of reaching their end point here. And so let's kind of do a bit of a retrospective of what's been happening. And then I'll also talk about not just the one big beautiful bill, which technically is not called that anymore because of a weird technicality and procedural activity. So some people are still calling it that. Some people are just calling it HR1, which, that's also not easy because every 2 years you can have a different HR1. But for one reason or another, let's just say that's what we're calling this large bill. And obviously, our focus at the accounting profession is mostly on those tax provisions in there. There were some other provisions that we were concerned about that we'll talk about in a bit that didn't quite make it through the process, um, but really we're focused in on the tax side of things. First, I want to talk quickly about like kind of breaking news here. At the end of last week, a bill that the AICPA has long pushed for actually passed in the Senate. It had passed in the House earlier in the year in March on unanimous consent, and then it passed in the Senate just last week, kind of surprisingly. We weren't necessarily expecting it. This sometimes happens in the Senate. It's something called unanimous consent. A senator can go down to the floor and just say, I asked unanimous consent that the Senate pass this bill. And if no one raises their hand in objection, boom, it's done. And this is now on its way to the president's desk for signature and will be law. And this is a bipartisan, bicameral measure that allows the IRS to grant tax relief whenever a governor declares a disaster or a state of emergency. Right now, even if a governor declares that emergency, the IRS has to wait for the federal government to declare an emergency, which sometimes can come weeks later. And what this does is it authorizes the IRS to postpone any federal tax deadlines that are coming up once the state issues that emergency, rather than waiting for the feds. So this will apply to any declarations that are made once the law is enacted. And this will just provide a little bit of relief. Look, we know that this is not, the sexiest or most important thing that people need in the wake of a disaster, but any way that we can provide assistance, that we're looking to do that. So this is great. And what's interesting about this is I'll get into it in a little bit, but this was a component of a broader bipartisan tax administrative bill, things that couldn't get done on reconciliation, but that are just to improve the taxpayer experience, and that had been long negotiated in a bipartisan way that the AICPA has been heavily involved in. And this was actually one provision of the bill that got plucked out as its own bill and now is going to be law. Um, So let's quickly talk about some of the wins that we got. At the outset of the tax reform process, the AICPA communicated its priorities to the congressional tax writing committees, and there were a few things that we made sure that we wanted here, and these are the things that we managed to get. And mind you, we communicated our top 10 priorities, and we got a lot of them. Um, so the first one, which we'll talk more about, was this pass-through entity tax for SALT deductions. Many of you heard about this. I'll talk more about it in a bit. But up front, I will say thank you to Connecticut and all of our state CPA societies. You all were crucial in getting this one over the line for us. A lot of times, there are a lot of situations where the grassroots matter, and this was one of them. But I'll come back and talk a little more in depth. We got a lot of wins on reporting forms, particularly the 1099K threshold that the Inflation Reduction Act had seriously lowered. And we managed to get that reversed just because of the burden that it was going to be for so many. We restored 100% bonus depreciation. We restored and made permanent the Section 174 R&E expensing, Section 163J business interest deduction. Section 529 accounts was a great win. We have been pushing for this for a while. This was something that, again, we'll go into more detail, but we managed to get that into law now. Um, Sorry, I'm having there we go. The Section 199A qualified business income deduction, this was also extended and made permanent. Again, the profession itself does not have the availability to deduct this, but we supported it for many clients of the profession. And so this was again extended and made permanent. Control foreign corporation look-through rule and downward attribution was another thing that got changed actually last minute to our liking. We got, the continuation and the certainty on the AMT. We supported a proposal for paid family medical leave tax credit extension that got included. Excess business losses, and there was legislation. This is a little confusing to understand, but there was a provision in the bill that would have prohibited the Treasury from regulating, prohibiting, doing anything on contingency fees for tax filing. The AICPA's position has long been that, with few exceptions, that, it's part of our ethics rules that, contingency fees, for general filing are not something that should be done. And either way, we believe that the federal government should have the ability to determine, the regulatory structures around that. There was a provision that would have completely prohibited Treasury from touching it in any way, shape, or form. We managed to get that removed. So again, like I said before, thank you. We got 53 states and jurisdictions, including Connecticut, to sign on to this letter that went to literally every single senator and representative in Congress about the PTET SALT deductibility, and that was crucial to getting this provision removed. And again, I'll go into more detail about what happened. But thank you again. Um, so let's talk about what's next legislatively. We've got two things that are happening. So the first thing, now that this is law, is, we're going to start to see the IRS and Treasury begin implementation. They're going to start first to issue, guidance, the guidance that they need most right away. And then as they start going through the bill, as Treasury and IRS start going through the bill, they might start to see some things that require a technical correction. Now, let me be specific here. Technical corrections is a term of art when we're talking about tax law in Congress. So when there's a technical corrections bill, it is typically done in a bipartisan way, doesn't accrue any cost. It is just various tweaks that, the agencies have said, hey, we think you meant this, but according to the law, that's not what it would do. So we recommend that you fix this. And again, like I said, it requires bipartisan sign off. Given that this was a very partisan bill, it's unclear whether or not we're going to see the typical technical corrections package that we might otherwise see on tax legislation. For example, we didn't get one for the Inflation Reduction Act. I don't know if we did, but I'm pretty sure we did not have one for the Tax Cuts and Jobs Act. And so how is this going to get done? Well, you might have heard the Speaker of the House and President Trump and other Republicans, particularly the chair of the House Budget Committee, talk about another reconciliation package. And so it's possible that rather than doing true what we would call technical corrections, they might make tweaks in the law through reconciliation. Again, it's unclear how some of those would get done because under the rules that govern reconciliation, if something doesn't incur a cost, then or a savings, then it is not eligible to go through reconciliation. So there might be certain specific things that they try and do that would have such an impact, either economically or cost-wise, that they would be able to get that done on this process. And so, TBD on what they do. What we've mostly heard on another, a future reconciliation package has to do with healthcare related things. But they have talked a bit about, well, if we have to come back and do technical corrections, we'll see what we can get done via reconciliation. The second thing that we can start to pay attention to, and when we say what's next legislatively, we're talking about in the tax space. What's next is this Taxpayer Assistance and Service Act, and this was that bipartisan tax administrative package that I mentioned earlier that we got sort of a win pulled out of it on its own. And this is a discussion draft. It was released on my birthday, actually, January 30th of this past year. Happy birthday to me. And it's often referred to as the Wyden-Crapo or Crapo-Wyden bill, the chair and the ranking member of the Senate Finance Committee. They released this draft and wanted feedback and commentary on it. The AICPA didn't really provide much feedback because we worked throughout the process in order to get a lot of things put into the bill. Now, there are a few things that have come up as time has gone on that we'll be in discussion with them on. In fact, I personally will be sitting down with the lead for the Senate Finance Democrats next week about this, just to see how it's going. Now that a lot of the partisan fighting is behind us, we want to get a sense of, will cooler heads now prevail on this package? One of the biggest notable provisions that we got included was a regulatory framework for tax preparers. And this was really important for the profession because there were a lot of, I guess we could say not so great actors out there. And we felt that there needed to be some sort of framework for how you regulate this group of people. And the big coup here was that we were able to bring together a coalition of different people, the AICPA led in pulling in the groups that represent the preparers themselves, as well as other stakeholders within the tax prep space. And we were able to come to an agreement on what this would look like and got all of those folks to endorse the legislation. Um, and so this is kind of one of the bigger changes here. But the bill does a lot of other things. And I apologize for the little Teams message now noise in the background here. I tried to turn that off. I can't get it to do that. So my apologies. But one of the other things that's in this, or a few of the other things that's in this bill, are things that the AICPA has been pushing for a while. So the idea of shifting to true quarterly estimated payment deadlines, something that we call the SAFE Act, which establishes a safe harbor for individuals. This would really help with the workload burden for those who file extensions to October. It would basically allow, rather than you having to do all of the work estimating what your clients might owe in April for them to pay what they would owe in time, in order to satisfy the filing the extension. This would basically allow a simple 125% of what they owed last year as their safe harbor. And so it would basically take off a lot of that front end workload so that things don't have to be done twice. And then it also would extend the mailbox rule to electronic submissions and payments. And so, this is just a little bit of a lot of what's in this bill and only a small selection of what is only a small selection of what would be of what the AICPA managed to get included here. So we're really happy to see this, and we're looking forward to seeing it go forward. Um, the other thing that outside of the tax space that Congress is going to be working on is government funding. And when I say working on, I mean I don't necessarily mean that they will come to a conclusion, but there will be some work on it. So obviously, each year, both chambers have to pass 12 appropriations bills. The House was supposed to have their first floor votes, or rather, on the military construction, veterans affairs appropriations, and defense appropriations. They've hit some procedural snags there, but really those are the only two that we expect to get done before they go out on their August recess. And then when they get back, they're in session for about 3 to 4 weeks before we hit that September 30th funding deadline. Meanwhile, in the Senate, they haven't even moved any legislation to the full Senate. They've only they tried to mark up some, and they got through a couple of their bills, hit a snag with another one. But if all 12 bills don't move on their own, which has what's been the norm for the past few years, they'll have to move what's known as a continuing resolution, which basically says everything we did last year, we're doing again. We're actually under a continuing resolution right now because the extensions that went into I think it was March of this past year, they couldn't get bipartisan agreement. They couldn't even get, quite frankly, agreement within their own Republican conference, particularly in the House, on what those spending numbers should look like. And so they basically just said, we're extending last year's numbers right through. And then, you might have heard appropriators, you might have heard Rosa, for example, but also Chairwoman Susan Collins in the Senate, Republican
Yes,
Chairwoman
yeah,
Susan Collins. Folks, please make sure you're muted if you can.
yeah,
Just
we'll see your associate tomorrow between 1 and 2. Thank you very much. Thank you. Bye-bye.
Sorry about that, Todd.
That's okay. Everyone, if you're listening, just double check that you are on mute during this, just so we don't accidentally hear background noise. So you might have even heard the chairwoman Susan Collins talk about the fact that we don't have enough of the information from the administration. We don't have all the different things that we need in order to move forward, and so they're trying their best despite everything else going on. So we're going to have to take a look and see how that moves forward. But it does indeed look like they're going to hit a snag. Separately, today, the Senate is taking up what is known as a rescissions package. And this is literally a process by which the administration tells Congress, we want you to rescind a bunch of these funds. And the reason this is a unique process is it basically avoids the filibuster in the Senate. It passes with a simple majority instead of that 60 vote threshold. It's caused a lot. Now, granted, there's no direct impact on the profession, but this will have an impact on general government funding because what Democrats, particularly in the Senate, are saying is why should we come to any bipartisan agreement on government funding with you if you're just going to come around afterward and follow through on this partisan rescissions package where you can basically undo all the things that we agreed as part of our concessions to. And so this is really going to upend that process over the next year and a half. We're going to have to see how it all plays out. Democrats in the Senate are not too happy about this, and the administration has said if we can pass this rescissions package, which is mostly focused on, public broadcasting and foreign aid, then they're going to come back and they're going to do more of these. And so that there's a question as to, well, why should we come to some bipartisan agreement, give you the votes you need to get over 60, if you're then going to come back in a partisan way and undo everything that we wanted to get in there? So this is going to be a continuing story. I think, we'll start to see the stories in September after everyone wakes up after Labor Day about what the likelihood is of a government shutdown. So let's talk about HR 1. What were some of the key tax provisions? Again, there's going to be a lot of detail here, and I'm not going to go into all of it for the sake of time, but we will make sure that you get copies of this. And if you have any questions, you can come back and ask us. So let's talk about the individual provisions. So very simply, we got permanent extension of the TCJA rates continuing through 2026. And when I say permanent, unlike under TCJA, this does not expire in 10 years. This is permanent now. Unless Congress comes in and changes the law, these will be the brackets. And obviously the thresholds are adjusted annually for inflation, but these will be the rates for those brackets. The personal exemption, so the permanent repeal of the personal exemption is done, as well as the permanent increase of the standard deduction that is also adjusted, of course, for inflation. We also got a permanent extension of the child tax credit, which is $2,200 per child. It makes permanent the refundable portion of the credit. And there are a number of other sort of guardrails around eligibility for that. But those are also, that's another individual provision that has been sort of taken care of and made permanent, right? And so a lot of times you guys have, I'm sure, heard about, doing extenders packages. What you'll find is that there's a lot less that are going to need to be included as extenders at the end of the year because this bill just made a whole bunch of things permanent. So the mortgage interest deduction, there's the permanent suspension of the home equity interest deduction, and there's the exception for mortgage interest premium returns. So for state and local, I know this is important in Connecticut. So there was an agreement amongst the so-called SALT Republicans, right? Those are the blue state Republicans who fought to get their increase in the state and local deduction. This is one of the things that is not quite as permanent as all the other things, and that was mostly because of the cost. So the deduction is limited to, it will increase to 40,000 in 2025, and it goes up 1% each year through essentially the end of President Trump's term. And then it is slated to snap back to 10,000 in 2030. And so in the future, under a future president and a future Congress, there will need to be some adjustment for this. Assuming that there's the appetite to do so, I imagine there would be, particularly if it's Democrats in charge at that particular point. Just because the blue state Republicans seem to be a dying breed. But but that will be an issue. It's an issue for not even the next Congress. I'm not even quite sure if I'm doing the math that it's an issue for the one after that. But this is one of those they kick the can down the road for the next 5 years. Um, it also applies an income, uh, 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 um, uh, I guess you'd say sort of a means test, right? So the SALT deduction does phase out starting at $500,000 a year for in income, and it kind of and that threshold also increases each year by 1%, as the same with the cap. So, but it will not phase out below the original 10K. So whatever your income, you at least have the 10K. But it begins phasing out. It begins phasing down, I should say, from 40 to 10, starting at $500,000 a year. And then for casualty and theft loss deductions, there is the permanent extension of that casualty or theft loss suspension, except for federally declared or state declared disasters. Though that, unfortunately, was something that we were advocating for getting rid of that cap. We felt it was unfair, and that unfortunately was made permanent from the TCJA. And then I'll quickly go through some of these other things. So, it, permanently suspends the miscellaneous itemized deductions. There was some relief provided for charitable contribution deductions. It permanently extends the AMT exemption, permanently extends the increase in unified estate and gift tax exemption to 15 million per person and 30 million for married filing jointly. Um, and it indexes that exemption amount to inflation. So again, the sort of again talking about how there used to be this sort of like cliff on the estate tax expiration that is now permanent. Um, and then here are some of the things that these are actually the four things the IRS just yesterday or the day before said that they are prioritizing providing guidance on. So these are going to be some of the first things that we see, and that is because these are things that were made effective retroactively to the beginning of 2025. And so people are going to need, and practitioners are going to need to know for people's 2026 deadlines, right, for filing for 25, how to do this. And mind you, for overtime and tips, this is going to be not just important for the individuals, but also for their employers, right? So the no tax on overtime, this is going to be, there are various guardrails on this. If folks have more questions on this, we're happy to share more info. I won't read through everything that's on the slide. The no tax on tips, the sort of one of the key things that the IRS is going to have to do is in the law, it basically says, historically tipped that it would be limited to historically tipped occupations. And that was a way of preventing, basically all kinds of occupations from just saying, well, we're going to turn your wages into a tip so you can avoid taxes. Um, and so it's kind of one of the first things for this on the IRS's plate is coming out with that list of what those occupations are. And I imagine they'll be working with the Department of Labor on that as well. This deduction for auto loan interest for domestically produced vehicles, that's another thing that IRS has said is a priority for guidance. And the deduction for seniors age 65 plus, you might have heard that Social Security sent out some very, very inaccurate notice saying that the idea of that it was included in the law that there would not be any taxes on Social Security benefits. That is false. That is not how it works. Because of the reconciliation process, the law that governs what you can and can't do under reconciliation actually specifically says you cannot make any amendments to the Social Security Act. So, and that was done because in their wisdom of developing this process in the 80s, Congress said, well, we shouldn't just allow a simple majority to make changes to such a big thing. So, so the way of getting around that, excuse me, is that they essentially provided uh, uh, an enhanced standard deduction for seniors that more or less is equivalent to what the taxes are that they would pay on their Social Security benefits. And so, but this is another one of those provisions. In fact, all of these provisions are those that are that expire essentially with Trump's term in office, and so these will have a cliff in 2029. I mean, yeah, these will have a cliff in 2029. Essentially, the cliff is really in calendar year 2030 because that's when people are filing for 29. So if these need to get extended, Congress has the opportunity to do that retroactively up until the end of 29, but we'll see what happens. That's a world away. Let's talk quickly about some of the business tax provisions. There are a number of extensions for TCJA provisions for businesses. You all will remember that under TCJA, the actual corporate tax rate was made permanent. So TCJA didn't touch that at all. But there were a number of other business deductions that were going to expire or that had already expired. So, as I talked about, permanent restoration of the 100% first year bonus depreciation, that is effective for anything acquired on or after January of this year. You'll notice that date, January 19th. And so, this is another retroactive thing that I'm sure IRS is going to have to prioritize guidance on for 2026 filing. Um, the Section 179 enhanced small business depreciation expensing. Again, this was also made permanent and this is retroactive as well. And then Section 163J business interest limitation. So this permanently reinstates, I've heard so many different people pronounce this different ways, but I'll just say EBITDA limitation under Section 163J. And so, um, uh, this is yet another one of those small business deductions that, was reinstated. So, originally we had seen a temporary reinstatement until 2029, but this ended up getting made permanent. And that was a lot of that was thanks to some of the what conservatives called accounting gimmicks in the Senate, where they basically said, anything that's law at this moment, we're going to consider it to have no cost, even if it's slated to expire. Um, and so I'll then talk quickly about some other businesses. So this paid family and medical leave credit that the AICPA supported, this gets permanently extended and it expands the scope of the credit. And the Section 174 research and experimental expenditures, another thing that got permanently extended and it allows for immediate expensing. And it's also, again, this is another thing that's retroactive. I won't go into the details again on this for the sake of time. Happy to provide more info here, but this was a high priority for the AICPA and became law. For pass-throughs, like I said, that Section 199A pass-through deduction of 20% on qualified business income was made permanent. They for certain types of businesses, they did provide a little more relief in the phase out. So under that what we call SSTB, specified service or trade service and trade businesses. that cliff was sort of, I guess you could say, it's less of a cliff, it's maybe more of a bluff. And again, happy to provide more details on that. And then again, the state and local deduction. So let me just quickly tell you what was going to happen here. Um, for those of you who remember, back in 2017, state and local cap was put in at 10K. Pass-throughs were concerned, we were all concerned that they were going to be subject to that. A lot of states, Connecticut included, in fact, 36 states, passed legislation that gave pass-through entities an out. They basically developed this system that we call the pass-through entity tax regime, and it allowed these pass-through businesses parity with corporations because there was no cap on corporate SALT deduction. It allowed pass-through entities to essentially, pay a pass-through entity tax, and then that would count as a business expense for deduction. I'm really boiling it down here, but that's essentially what it was. The House legislation essentially said, yeah, no, you're not allowed to do that anymore. And not only did it say you're not allowed to do that anymore, but it also, the way they drafted it, pulled in a whole bunch of other things, like franchise taxes and other things that had always been considered deductible, even if we didn't have the PTET regimes at the state level. It pulled those things in and said, yeah, no, you have to separately state these items, and they are going to be subject to the cap. Um, that actually, kind of surprised everyone. And we kind of went into overdrive to fix that. In the first draft of what the Senate bill released, and by the way, I will say that when that happened, the former chairman of the Ways and Means Committee, who wrote the TCJA, tweeted that it was never the intent for pass-through businesses to be subject to the SALT cap, that they did not mean to provide such a disparity between, business C corps and other kinds of businesses, and that disparity was unfair. And so, we all went into overdrive on this. When the Senate released their initial draft, they kind of split the baby. They said, okay, if you're, you can basically take half of what, this deduction would be. And then when we got the final version of the bill, which was, the substitute amendment, just the day or two before they took the final vote on it, all of the language was completely stripped out, that would have prevented, or that would have prohibited PTEP. And so we're basically at status quo. Now, for many, the overall, SALT cap was increased, but again, this was essentially left as it will be, or as it was rather. And that was, when they say no news is good news, when we read the bill and we found nothing relative to that. When you find nothing, that means it's staying the same. And we saw that the language was taken out, and we were all very happy about that. But it is thanks in no small part to the grassroots activity, the outreach. The nice thing is that every congressman, if they're smart, they have a CPA. And so we were able to leverage that to make sure that they heard about what this would mean, not just for the profession, but for, thousands of clients. I should say more than thousands, millions of clients of CPAs, who themselves are pass-through businesses. And so, we can talk also about Section 461, but this excess business loss deduction. But this is yet another item that was extended and made permanent. So. Just some other key business provisions, small business stocking exclusion, corporate charitable deduction. This is uh, sort of another provision that was thrown in to kind of provide relief for the charitable deduction issue. So after TCJA and with the increase of at least on the individual side, with the increase of the standard deduction, there was a lot of impact to the charitable sector because of the availability of that deduction. And so these were some of the ways that the legislation tries to address some of those concerns. Um, I'm not sure how many of you will find the international tax provisions as pertinent. If you do, I will make sure you guys have the slide, but I want to make sure that we leave at least 8 to 10 minutes for Q&A, and there are some other things that I want to talk about outside of this bill, or some other things that didn't happen or happened in this bill that we need to keep an eye on for the profession that aren't just tax related. If you are super interested in this, I'm again happy to provide updates on that. But what I want to at least make sure of is that we have time at the end. But obviously there were a lot of different changes that were made for global intangible low tax income and foreign-derived intangible income. It changes the name of it. It kind of tweaks with how it works. Again, I don't want to go into too much detail here, but these are the major provisions of the international tax stuff. The big thing was that this so-called revenge tax, Section 899, that had been in the bill, that got removed because of a sort of handshake agreement that the Treasury Secretary was able to get with G7 nations. You may have seen a lot of stories about how a lot of countries are now delaying or repealing or putting off their digital services taxes. There's been, some agreement on basically allowing whatever the U.S. law is to be considered in compliance with Pillar 2 of the OECD agreement, which is essentially the global minimum tax. So a lot of this was informed by those negotiations that were going on. And then again, some other tax provisions that are in the bill. So the employee retention credit, there were some issues with doing this writ large that had mainly to do with the fact that because much of the ERC was done through payroll taxes, Social Security Act, you can't do Social Security Act on reconciliation. There were actually only 2 quarters of 2021 where they basically allowed for the deduction to have to be on not through payroll taxes, and so those were the only quarters that they could actually touch. And so this basically sets up the definition of what a promoter is, increases the penalties, but again, it only applies to those 2 quarters. Section 529, this was a huge win for the profession. We've been pushing this for a while. But this expands the use of 529 plans to be used for post-secondary credentialing. And that includes expenses related to attaining and maintaining CPA licensure. Those expenses are now deductible, and it increases the annual withdrawal of tuition expenses. It's effective after date of enactment. So, and then Section 4960 excise tax, it amends covered employees to include all employees of an exempt org. So this is more for EOs, but just want to highlight some of these and particularly that. And as I mentioned, the Form 1099 reporting, that threshold had come down as a result of the Inflation Reduction Act. It was going to be $600, and we basically got oh, sorry, not Inflation Reduction Act, the American Rescue Plan Act. It basically repealed all of that. So we're back to what it was before. It increases the reporting threshold back up to 20,000 and over 200 transactions. And then there are also these changes, 1099 NEC and 1099 MISC. Again, we're running low on time. If you have further questions about this, these slides are going to be shared with you. And if that doesn't satisfy your questions, then we can always follow up. And then same goes for the energy credits. I'm sure you all know there was a lot of changes to the energy credits. It is all still being figured out because some agreements that were made in order to get some supporters of these credits on board in the Senate to pass the bill. Um, Kind of ticked off some of the more conservative members in the House who wanted to phase these out faster. There's a bit of confusion here because they thought that they got certain provisions in that kind of softened the blow, but then the president issued an executive order. And so there's going to be, this is going to be another one of the priority areas for IRS to start issuing guidance. And we'll start to see some more stuff come out, particularly given that particularly given that the president has issued this executive order. Um, and then, yeah, again, more about these energy tax credits. We're running short on time, but again, if that's an area that of concern to you, we'll make sure to provide all these slides. Um, I talked a lot about the IRS implementation, so we'll start to get proposed and final regs, IRS revenue procedure, revenue rulings. There's going to be form publication changes, IRS notices, FAQs, announcements. The AICPA will be communicating this to members as updates happen. This is obviously going to be a key part of the rollout, and we're going to be there with you every step of the way. What is our regulatory advocacy process at the AICPA? So we'll be identifying the emerging issues. We're going to develop positions through our committees in each of we have many committees that some of you maybe even be members of, and then we have our tax executive committee. We're going to be developing those recommendations, issuing comments, working with Congress if legislation is required to fix any issues, making sure that the forms make sense, and also making sure that the service levels are there to respond to the questions that we have about this, because this isn't all happening in a vacuum. We need to make sure that the IRS has the resources to implement this. And then obviously we will be representing CPA tax practitioners before the government, the public, and other practitioner groups. Um, and I'll just quickly talk. There was a successful 2025 filing season in spite of all of the upheaval. But so many of the changes that were announced to all of the IRS staffing came after. And so we're going to be watching to see what happens in October because that's really going to be, between implementing this law and dealing with October filings, that's going to be really the huge indicator of how things are going. And then if y'all want to snap this QR code, this has two of our publications, and obviously additional resources will be coming soon, but two publications that will probably answer all the questions you had and that I either didn't get a chance to or could not answer. And so, happy to answer any questions you have or get answers to any questions you have, but you might have more detailed information in either of these publications. I want to quickly talk about a few things that were outside of tax, and then we'll open it up to questions. I'm sure some of you heard about legislation or provisions in the bill that would have transferred the PCAOB to the SEC and eliminated the fees that basically fund the PCAOB. That was ruled to not be compliant with the reconciliation process, so it got stripped. However, there is standalone legislation, and we've actually heard some bipartisan rumblings about, taking another look at how the PCAOB and how the structure of regulating the profession is organized. And so, this issue isn't going away. There is still standalone legislation that could gain traction. There's been increased criticism of the PCAOB and, breaking news last night, the SEC chairman dismissed, technically asked for and then accepted the resignation of PCAOB Chair Erica Williams. Now, over the past couple administrations, the SEC chair has dismissed the entire board. That hasn't happened quite yet. And the other thing I would point out is that the Trump administration has openly said that they are not going to fill Democratic positions on the board, on boards. They're only going to fill the Republican positions. So unclear what that means for the PCAOB, but right now, at least, Erica Williams is out, and there will be a lot of news in the coming days on this. The other thing that the Financial Services Committee in the House is taking a look at is General Sarbanes-Oxley review. And so they held a hearing on reassessing it and the cost of compliance. There's a lot of focus on compliance costs of 404B. There is draft legislation to raise the 404B reporting threshold, which would exempt a lot of companies currently required to comply. The legislation hasn't been introduced by anyone to date. This was just a draft bill, a discussion draft that was kind of put up for consideration at a hearing, but it hasn't been marked up, it hasn't been introduced, so on and so forth. But we're keeping an eye on this, and we have, concerns about what that would mean for broader sort of, the whole reason we put Sarbanes-Oxley into law in the first place. Again, like I talked about in the last slide, I mean, this would exempt this draft legislation would exempt about 700 companies who are currently required to comply with 404B, 14 of those in China, 9 in the UK, 7 each from Bermuda and Israel, Bermuda obviously being a well-known tax haven. So, the committee is looking at a general capital formation package. That is the eye, or that rather the lens through which they're viewing this, is that it's part of generally, promoting more capital formation. We've had conversations with Capitol Hill staff expressing our concerns, and we're going to be keeping an eye on this. And then there's also been a bill introduced by Troy Downing, a freshman member from Montana, to reorganize the Securities and Exchange Commission. It would consolidate some divisions within the SEC, most notably move the Office of the Chief Accountant into the Division of Corporate Finance. There are some expectations that we could see Chair Atkins start to make some organizational changes from an executive standpoint soon, but there are some things that would require legislation. But we could see this bill get amended to reflect some of the changes that the SEC will have already made. And then finally, our STEM bill. We did reintroduce the Accounting STEM Pursuit Act. Thanks again for whatever outreach you've already done, and please continue reaching out to your representatives. We've got 5 folks in Connecticut. One of them is a senior member of the Education and Workforce Committee where this bill has been referred. So we would love to continue to see, or actually 2 of them, I'm sorry. So we would love to continue to see support and folks sign on as co-sponsors. We're nearing, I think we're nearing 30 now. We had about 60 at the end of the last Congress. Our goal is to get 100 because that's just a marker that in the House will show, hey, we're serious about this. And so please continue to ask your representatives to get on board. And then Crypto Week, we're going to start to see legislation move. The biggest one that could become law is the Genius Act. This is legislation to regulate stablecoin, but the House has been pushing its version of legislation that would set up a comprehensive regulatory framework for digital assets. The House and Senate aren't quite in agreement on that. And so what we do expect is that the stablecoin bill, there was a bit of a snag yesterday, but it seems like it's been resolved. We do expect that the stablecoin regulatory framework bill, which was passed by the Senate, will end up getting cleared by the House and sent to the president for his signature before by the end of this week. And this would be really the first regulatory step in the crypto space. All right. Any questions? Since we started a few minutes late, I'm happy to stick around for a little bit, such that we can do that to take any questions that came in.
Todd, we did get a few questions in.
Uh-huh.
We do have a couple minutes, so let's and any that we may not get to, I can certainly send to you, Todd, and I can get back to our members as well. Let's see here.
And feel free to like group them if there's a bunch of questions about X, Y, or Z. I'm happy to hit on those.
Okay. Um, auto deduction, auto loan interest. How do we know where the auto was assembled?
Yeah, these are a lot of the questions that the IRS is still going to have to work through. So we're
Okay,
going to have to wait for that IRS guidance. I think it's going to require a lot of input, both from what's publicly reported. We're basically TBD. We're waiting on that guidance information in order to figure that out.
okay. Um, cash basis taxpayers and inventory. So big changes regarding cash basis taxpayers and inventory. Can you explain?
Say that again. I'm sorry.
So there are some big changes regarding cash basis taxpayers and inventory.
Off
Any?
the top of my head, I can't explain, but if you shoot me a note on that, I will make sure to get the folks who work in that space some more information. Or I can find out if we have. We might in the booklets that I put up the QR code for, we might have some more specific information there.
Great.
Um, so yeah.
How about R&D? Any guidance on R&D for 2024 for the extended returns?
That's one of the things that they're working on in short order because they know that folks are gonna need that soon. We're gonna stay on the lookout for that just to be sure that we communicate that back to our members.
Okay.
Again,
Okay.
like the ink is barely dry and the IRS is working through it. I know that there are some like it wasn't just a clear extension. I think they did make some changes to it. So we'll have to take a look and see what the IRS does come out with.
Great. Well, I know, I mean, a lot of folks may have to go. It's 10:01. Todd, we really appreciate all of this. And again, just to remind everybody, we'll make Todd's slides available to all of you. I'll get those out through email. Thank you, everybody. Thank you, Todd, so much.
Absolutely.
All right, everyone. Have
All
a
right.
great
Thanks
day.
again. Be well.
Bye-bye.